Hello, accounting students. Professor Lewis here. Want to go through today, take you through a review of how to calculate tax liability when you have capital gains. In particular, when you have 25% and 28% gains as well. So more than just we did the junior core of 0, 15, 20, just that bucket. We recognize that preferential gains might include 25%, which is unrecaptured 1250 gain, which is gain that we experience from the sale of real property, where there's gain generated because of depreciation taken, and that gain is allocated to an individual. So we're just going to call it 25% gain and not get into all of the how do you calculate it and recapture 1250. The third category of capital gain income, preferential, is 28%, which is collectibles and something called qualified small business stock. Those can both be taxed at 28%. So what we want to do now is just go through, we just want to go through and talk about how do we tax those types of gains with some ordinary income and see how they all interrelate with each other. So there's a formula, and I list all of the steps here on the slide deck that you have access to, and that's fine. And if you want to copy down the slide deck to get a better sense, that's great. For me, I think the example works better. It's more of a visually learned thing. But essentially what you're going to do is you're going to calculate your taxable income first. Just come up with whatever it would be. Just ignore character for a moment. Get down past your AGI, get your from AGI deductions in there, which are going to include itemized or standard, whichever is higher. You might have a QBI deduction. If you don't take an itemization, you take the standard deduction for 2021, you're going to be eligible up to a $300 or $600 charitable contribution from AGI. And we'll talk about that in due time. But in any event, you get down to taxable income. Once you have that, then what you want to do is take your total taxable income and subtract out of it your preferential gain. 100% of your preferential gain, your long-term capital gain. So it could be the 0, 15, 20, the 25, or the 28. What you're going to be left with then is essentially your ordinary income. Now that would be short-term income, it could be or short-term capital gain, it could be wage income, it could be interest income, other income, royalty income, anything with an ordinary income taint. You're going to be left with that, and essentially, by the way we've done the formula with taxable income, you will have subtracted out all of your itemized deductions. So you're really going to be left with just your ordinary income after your deductions with your preferential gain, 100% of it. Okay, so then what we're going to do is we're first going to tax just the ordinary income, look at it using the normal ordinary brackets, see where we are, and then based on how that comes out, then we're going to then look to tax of the three character types. Let's say we have gain of 25%, 28%, and 0, 15, 20. The way the ordering goes is you first tax the 25, then you tax the 28, then you tax the 0, 15, 20. Now, a couple of things about this. When I say 25%, here's the key to understanding this. I'm not saying that it's taxed at a flat 25%. When you say 25%, what you're really saying is it's taxed at a rate no greater than 25%. It certainly could be lower than 25%, because what happens is you're going to take in your base, you're going to have taxed your ordinary income in step one, then you're going to pour into the ordinary brackets your 25% gain. And to the extent that that gain would be taxed at a rate lower than 25, you're going to tax it at 10%, 12%, 24. You're going to keep going. And then as soon as you leave the 24% bracket and then bump to the next ordinary bracket of 32, you'd stop taxing it, and whatever's left over will be taxed at a flat 25. In other words, the 25 label just means it won't be higher than 25, but if your ordinary income rate was lower, you'll get the benefit of the lower rate. All right, how about step 3? After you've done that with a 25% gain, let's assume that you still have some ordinary bracket left, the 24% bracket, and you have some 28% collectible gain now. You're going to do the exact same thing. You're going to pour the 28% in and tax it all the way up until you would leave the 24% ordinary income bracket, and then as soon as the next dollar would go to 32%, where you'd be taxing it higher than 28, you'd stop and tax whatever's left over at 28%. Then at that point, then you say, okay, I'm going to put all that aside, and then I'm going to say, what's my total income tax so far? Ordinary, 25, and 28. Now, Whatever I have left over, the 25 and the 28, remember when I said, well, if you're going to go into the 32% bracket, you stop and that other part gets taxed? This is how it technically works. You do the ordinary income, everything you can tax at 25% or below, so the 24% bracket, anything you tax at 28% or below, which would be just the 24% bracket, then anything additional above on those two categories, you actually just put those aside. And here's the reason why. We know they're going to be taxed at 25 max and 28 max eventually, but the thing is that for this next step, the 0, 15, 20, it's taxpayer friendly. All I'm going to do is say, okay, push all that aside, and I'm going to look at my breakpoints for the capital gains and say, okay, I've got ordinary 25 and 28. Where is that? I'm going to look at my breakpoints. Then I'm going to put my 0, 15, 20 gain in and tax it. And if I'm below the 0 and the 0, then I tax some portion of 0. Then I might tax at 15, and then some piece might be at 20. Then once I've taxed that, then I go back and say, okay, now whatever I had that was excess for 25, it's just at a flat 25. Whatever's excess is a flat 28. And the reason why is because if I put the 25 max and the 28 max in, it would bump my breakpoints up, and it would make more of my 0, 15, 20 tax at a higher rate. And we don't do that. Then when we're done with all that, I add it all together, and I come up with a number. So the best way to illustrate this is with an example. First of all, let's remind ourselves for 2021, here are my breakpoints. So if I have ordinary 25 and 28, I'll add it together, and that's less than, let's assume I'm married filing joint. If that's less than $80,800, then the next dollars of 0, 15, 20 that I put in there will be taxed at 0% rate until all that added together equals $80,800. Then the next dollar will be taxed at 15%, all the way up to $501,600. Then if I still have gain left over, the excess would be taxed at $501,600. This reminds us of married filing joint or qualifying widower. But these are the brackets. And so when I talked about ordinary brackets for the ordinary income, the 25 to the 28, this is what we're pouring it into. And you can see that to go from 24% to 32%, right, you've got to be at taxable income of $329,850 or higher. So if my ordinary income, my 25 and my 28 is below $329,850, then all three will just be taxed like their ordinary income. There's no reason to tax it at a max 25 or 28 because I haven't jumped into the higher bracket where it would matter. So let's just look at our example. Jeff and Mary Sorensen, married filing joint, $700 taxable income. So I've gone all the way to taxable income, right? Then I'm going to look at my character of gain. I've got QDI, qualified dividend income, 0, 15, 20. Remember, QDI is long-term capital gain tax rate. So really, I've got 580. If I want to say it, I've got 580 of 0, 15, 20 because I'm going to combine those two. I have 60,000 of 25 and 50,000 of 28. We're not going to, for today, go into how I got those calculated, but these are my numbers. Okay, so when I add up all this preferential gain and I subtract it from the 700,000, that means that I've got 690 less 700. So what's my ordinary income of my taxable income? Well, I'm down to 10,000. So I may have had 100,000 of taxable income, right, to start with. I may have had $800,000, let's say, but I had a whole bunch of itemized deductions. So the way the formula works, you come down to taxable income after all your deductions, you subtract out 100% of your preferential, your long-term preferential, which is 0, 15, 20, 25, and 28. Subtract all that out. Now I'm left with an ordinary of 10. So now all I'm going to do is go back to my steps, and you can see these are coordinated with the narrative. I'm going to tax the $10,000 at the ordinary brackets. Well, if you look at the ordinary brackets with me for just a second, you can see that for married filing joint, they don't kick to the 12% bracket for 2021 until $19,900. So I have $10,000 here. So all of it's going to be taxed at 10%, $1,000. Okay. Now the question I want you to look at those before I leave this is how much more of the 10% bracket do I have left? Like I've had other ordinary income, $9,990 would be taxed at ordinary rates. And that's important because now what I'm going to do is I say, okay, I've got my base of 10,000 in my ordinary brackets. I'm now going to pour in the $60,000 of 25% gain. And when I do that, I'm going to say, okay, I'm going to tax that like it's ordinary income unless some dollar goes above the brackets that would go from 24 to 32%. So I have $9,990 left of the 10% bracket, which would leave me approximately what? $50,000 to tax at the 12% bracket if it was big enough. And then if you look here at the narrative, it says, to get to the 24% bracket is $309,850. So of income left. So what I'm trying to say is, like, to get from 24 to 32%, it's $329,850. I've already taxed 10, so I've got to have more than $319,850 before I would bump into the next. So first thing I'm going to do is take out the $9,990. Okay, that's how much I have to get from the 10% back to the 12%. And then what I have is then I have to say, well, how much do I have to go from the bottom of the 19,900 up to the 329,850? Because that's the real number, right? I can tax at 12, 22, and 24, but then that's when I would leave, and that's when I'd have a challenge. Well, 309,850 is what I have there, right? So I got plenty for the 60. So all I do here is I just tax the 60 like it's ordinary income. So I've got 9,990 at 10%. I then have a bracket of 61,060 of the 12% left because that's 81,050. You can see where that kicks in. So that whole bracket there of 12%, you're going to tax that income of 61,060, right? I've got left. So I have enough to take the 10 and the 12% bracket. So I'm going to take the 10% times the 990, and then I've got 50,010 left over. I've still got plenty of room, 12%. 6,001. I add those together and I end up with a total tax of $7,000. Okay, now what I'm going to do is the same thing with the 28%. Now what I'm going to do is say, okay, let's assume I could tax the 28% of $50,000. Let's say it's ordinary income, and where would that fall? Well, I've already just bumped up $70,000 of income. 10 of ordinary, 60 of 25, we were fine. Now I'm going to take it up another $60,000. So how does that work? Well, as I'm looking through this, right, same basic thing. As I'm working through this, I have so much of the next bracket. I've got 11,050 of the 12% bracket left. Then I've got some 22% bracket. I've got 91,700 of that. And then I'd have 24. Well, I only need 50,000. So it's clear that some piece would be at 12. 11,050, and that'd be 13,626 of tax. And then how much more tax do I have? How much more bracket do I have to go from 170 to 750, which is where the 24% bracket starts? So 91,700, I got plenty of room. So I'm just going to tax that at 22%. Now, when I add all these numbers together for this $120,000 of income, the 10, the 60, the 50, my tax is $17,895. So essentially, I've just taxed all of this like it were ordinary income. Now, if I knew I had plenty of room, I could have saved time. Sometimes I get a question, could you just cut the corner and just say, look, I've got 120, I got $120 of income, I'm going to tax it at ordinary income rates? Yeah, but you got to be careful because at some point I could give you facts that would exceed the ordinary brackets where the 25 or 28 would essentially cap out. Now, had the 28% been massive, and let's say we capped out at that 329 or whatever it was. Go back and just give you an exact number. Let's say we're at the 329,850. Okay, whatever is remaining, whatever is over that, you would put aside and not tax yet, just leave it. Then I'm going to do the 01520. So now I have a base. My base is what? 120,000. That's what I've taxed of income. And I've got 580 now of 01520. That was the QDI and the long-term capital gain combined. You can see here that married filing joint, the zero bracket, we leave it at 80,800, and because I'm already at 120 with my ordinary income rates, I'm already into the 15. Then the question is it all taxed at 15, or do I actually exceed the 501,600 in total, which would be ordinary income plus long-term capital gain up to 501,600 is taxed at 15. Anything above that would be taxed at 20. Well, look at the numbers. So the first break point has been passed, no problem. The second breakpoint of 501 over the 120 means I have 381,600 of income to go at 15, but my gain is 580. So that means 198,400 exceeds the upper breakpoint, so it's at 20%, and the 381,600 is at 15. So then the last step would be, okay, now let's go back and grab the scraps. So if I have anything that exceeded the 25 max or the 28 max, I'd add those in here at a flat 25 and 28, but I don't have anything. So then all I'm going to do is add up all of those numbers together to come up with my tax of 114,815. There's a little rounding thing on that 25% gain, depending on if you're playing along at home, working this out. Depends on how you round, but this is just giving you the idea. And then all I would do to kind of complete it would be, well, what's my effective tax rate? 16.4. Yeah, it checks out. Makes sense. That's about what you'd expect. So this is an example. This is how you would do taxes, tax rates if you had 25, 28, 0, 15, 20. If you have any questions, like always, please feel free to come see me. I'd be happy to help you. But if not, I hope this has been helpful, and we'll talk to you in class. Thanks.